13 options trading lies that you've been told. Now, that's a little inflammatory. Not all of these are directly what I would call lies, but there are a lot of misrepresented data points that are super misleading to people. So the goal of this video is to walk through 13 of them, what they are, and then to give you the reality around some of them, hopefully, so that you can make better trading decisions. Let's get straight into it. So this is actually a post that I recently did on Reddit not too long ago, and it serves as a great spot for us to start the conversation. And I'll be able to add way more color around these, obviously, because we are on a video. So the first one you see here is 90% of options expire worthless. And the reality, this is not true. The overwhelming majority of options are closed before expiration, 55 to 60%. Of the total option contracts that are opened, about 30 to 35% of those expire worthless. So the reason why this matters is because sometimes when people will say like, oh, I like to sell options because most of them expire worthless, it's not the case. And it's important to differentiate. That's why I highlight a lot of these. It's not just because the fact in and of itself is wrong, but it's the implications of what the lie is in this context. So you can look at this data, the OIC or SIBO, whatever your preference is, but the Cliff Notes version is most options are actually traded before expiration. The next one is the follow-on argument of, but that means most options that are taken to expiration expire worthless. That's correct. And it doesn't matter. The reason why it doesn't matter is because, again, the implication of the first one are people typically taking that to think that we're better off selling because of this, and it's not the case. So that follow-on argument point is really just more pedantic than anything. Again, it's not wrong, it's completely fine. But what I'm most interested here are the rationale and the implications of things, which is the next one, is selling Theta is an edge. The answer to this is sometimes. It inherently is not an edge. Theta is simply the measurement of time. So when we think about an option has two parts of the premium, intrinsic and extrinsic value. Extrinsic value is broken off. It has time, which is, we know time. Time is defined at the onset of the option. Time decays linearly. And then there's volatility. The volatility component is where there can be edge in selling Theta or selling options for the sake of collecting Theta. But the time frame that it makes sense is not always, and it's actually relative to the relationship between implied and realized volatility. So if we take a look at this down here, you can see that there are periods where implied volatility exceeds the same time frame for realized volatility, and then other times it's the inverse. So in this case, if you sell Theta here, you actually can lose money because the realized volatility is more volatile than what's implied, which is what's priced into your options when you choose to sell. Now, a couple Cliff Notes versions for general context here is if you're looking at things like SPY, well, this very often will have risk premiums. So if you take a look at this chart, this is going back 6 months, notice that there is this one period, this was back that moved during August of this year, where realized really picked up a bit compared to implied. But generally speaking, the indices are going to have risk premiums. So it is absolutely okay and safe to assume in general, you can find risk premiums through selling strategies. You can say that. The problem is that unless you're delta hedging and purely isolating volatility, which most people don't, you're not fully exposing yourself to this exact phenomenon. And again, the implication here is people will automatically default to selling because they think that selling always has an edge, and it doesn't. In something like S&P 500, it very often will, but it's not always. So it can be really misleading. The next one, this one's really native to the people that trade the wheel, which is when we say things like, I'm going to sell puts to buy stock at a discount and collect a premium. That sounds great, doesn't it? Sounds really, really good. Here's the problem. if you sell a put, let's take a look at an example in something like SPY. And you come in here, you go 49 days out, and you grab these 30 delta short puts, the 592s, and you sell them. When you sell a put, you are taking undefined down to zero risk, and you have defined profit. What's the payoff for that? Why would somebody take that trade? Well, it's typically because implied volatility is overpriced. So you have a little bit of a structural edge when that is the case. And the second component is you have a bit of a buffer space to be wrong. So spot price right now is like 603. It can move all the way down to here, which 586 and change, and you can still hit a profit. So you get a bit of a buffer room. That's also great. The problem people have when they sell puts with that kind of mindset, the first thing is not comparing it to any other strategy, but at the time of expiration. If you're assigned a put, let's say the stock drops to 570, you're buying the stock in this context at 592 when spot price is 570. You're literally buying it at a premium at the time of expiration. The reason why that matters is because when people say things like this, they're only trying to focus on the elements of the trade that they like, that sound good, that comfort them. And they're not actually thinking about what the reality of the position might look like, which sometimes can be kind of ugly. So if we take a look at something like Tesla, and let's zoom out, let's do like a 3-year daily. If you sold puts in here, and let's say that you're like, oh, I would love owning Tesla at 302 back in 2022. We just think that's a bargain. What a great spot to be able to get Tesla. So I'm going to sell these puts so that maybe I'll get assigned at a discount. But here's the problem. When it's at a discount relative to when you sell the puts in time frame, there's a reason why it's going down. So the original calculus that you had that decided that it was a discount at the time of selling the puts might not still be a discount in the scenario that you're assigned on the puts, because things change. That's why the underlying price moves. So you might find yourself getting assigned at 3 and change, thinking that you got in at a steal until it drops to $101. So the main issue here is not selling puts. I sell puts all the time. Selling puts is fine, but it's the way that people do this and the tricks they play because they want to feel comfortable. Now, if you really want to sell puts to buy a stock at a discount, guess what we do? Rather than coming in and selling some sort of 30 put, you need the underlying to drop a bunch to get there. So maybe we actually sell something that's slightly in the money. Maybe we grab the 350s or the 355s that are like a 50 delta. You're going to collect a ton of extrinsic value and your probability of being assigned is much higher, which is what we're saying we want. So you're actually getting the stock at a little bit of a discount because of the premium received to current spot price, and you're collecting way more money to do it. But alas, most people say that they're really comfortable with assignment until the stock drops 15%. And then all of a sudden they don't want that to be the case. They don't want assignment anymore. Rightfully so. Conditions change. All right, next one. To make money on a long option, you need the stock to be at or above your strike price. This is only true at expiration. This is a really common mistake. Going back into Tesla, let's say that we think Tesla is going to go up. We're going to go out about 90 days. This is 84 days to expiration. And let's say that we go really far out of the money and we grab these 500 calls, super far out of the money. And we take a look at, there's 2 lines. There's a purple line, which represents today. And then there's a blue line, which represents at expiration. At expiration, you absolutely need to be above your strike plus the premium you paid in order to make any money. At expiration. Notice what this purple line does well before expiration. As soon as Tesla starts to go up, isolating delta, meaning volatility isn't changing and not focusing on time decay yet, this means that the underlying appreciates. The options, call options, will appreciate. You will make money. So in this case, you have the 500 calls. Even if Tesla goes from spot price today, which is 345, to 350, you make $70. That's nowhere near 500. It's nowhere near your strike price, but you still make money. So the caveat here is you do have to make sure that you're overcoming any changes in volatility and any changes in theta, which is actually why A lot of times I go further out in time, like this 84 days to expiration, because if you take a look at the theta here, it will be much less. Theta here is 15 cents. If we come into this 21 days to expiration, we go to that same 15 delta. You take a look at theta, it's 25 cents. It's nearly double. So that's the trade-off there. I have a video that goes super far into detail on buying call options smarter to balance all of these things, including gamma. But for this specific point, you just need to know you don't need it to go above your strike price in order to make money. You make money quite a bit before that. The next one, you can't go broke taking profits. You absolutely can. And this is for a very specific reason that's pretty simple. It has everything to do with expected return. Sooner or later, risk is going to be realized. What I mean by that is, so we have 9 winning trades, 1 losing trade. You're making $50 on each of those winning trades. So it's really high win rate, 90%. However, on that one loss, if you lose $475, your gross overall expected P&L here is negative 25 bucks. You lose money. So why? Why is that the case? You can't go broke taking profits. Well, the problem is sooner or later, if you continue to trade, you're going to have a loss. So the only scenario where you can't go broke taking profits is if you don't have a losing trade, which we're all going to have at some point. So it's a completely broken saying that forces people into something called the disposition effect, which is really well studied. And it is where traders have a propensity to take winning trades down too fast and let winning trades run too large. And these kinds of sayings feed directly into that. The way we need to manage trades is based on expected return. It's not about little sayings like you can't go broke taking profit, because sooner or later you're going to have a losing trade, which can hurt. The next one, buying is better than selling, or selling is better than buying. The punchline here is neither is better. They both have a use case that's really important. And if one was structurally better than the other, nobody would do the other. There's lots of smart people in markets. So they have use cases. They both have pros and cons. It's up to you as a trader to determine what's better for what you're trying to do. I both buy and sell. It's entirely context dependent. The next grouping, options are zero sum. So in a nutshell, they absolutely are. Now, I want to talk about what this means though, because most people, when they say options are zero sum, it simply means that in order for one option to make money, the other option on the other side is losing money. This is looking at the option contracts in a vacuum. And again, it's completely correct. The problem is the mindset that it infers against the reality. The mindset it infers is that because options are zero sum, it means that the counterparty on the other side of the trade is also probably sophisticated, that might know more than you do. And there's a reason why they're on the other side of the trade that might be smarter than the reason you're getting into your trade, or something along those lines. The problem is multiple fold. The first thing is the counterparty to your trade is probably a market maker. Which, fun fact, the market maker doesn't actually care that much about how much they're going to make on the option itself. It's a bonus, but they make money off of providing liquidity and capturing the bid-ask spread. So this is where we remove ourselves from the vacuum of just comparing options themselves and what that might infer against the reality of markets, which is typically the counterparty to your trade is a market maker who's going to make money by providing liquidity. The next important component is that the overall process that somebody's placing a trade for is different. So for example, let's go back to our example in Tesla. And let's say that we have a short call. Well, if somebody sells a call, the general inference is, oh, they want the stock to go down, right? Options are zero sum. So that means if I'm buying a call, somebody's selling the call, and the person selling the call obviously wants the stock to go down. Maybe. Or maybe they have 200 shares of Tesla as part of that position, and they actually want it to go up. They're just collecting some premium against their long shares, and they're actually bullish. They might actually have the same thesis you do, but they're putting a position on that might make sense for the portfolio. So the reason why I call this out is because the inferences people make from it that lead them to incorrect conclusions. The reality is markets are very diverse. There's lots of reasons why people are doing things. So if you take the inference that there's zero sum to mean that somebody is directly opposing your idea for a potentially better researched idea, it's misleading. The next one, to make money, you need to emulate what institutions do. This one's pretty simple. The fact of the matter is institutions are playing a completely different game than you. That's what it comes down to. So there are elements that an institution exhibits that are great to model. Things like having a rigorous process, checks and balances, training, those kinds of things are great. But the function of a market maker is completely different. You, as a retail trader, are making money off of speculating. A market maker makes money off of providing liquidity and managing risk. Literally a completely different game. So when people come out and say, oh, my friend is a hedge fund manager, or my buddy does this, or I was a former whatever, it's cool to have that experience, but there's a reason why a lot of people that move from professional trading into retail trading don't do as well. And it's because they're just different. It's different games. So I would think really carefully about what elements of institutional professional trading you try to pick up as a retail trader, because they're doing things differently. And I actually use a very specific example here at the end of the post. It says, taking the applicable elements is great, obviously, of institutional trading. That makes sense. But trying to emulate what they do is akin to emulating playing basketball like Shaq, even though you're 5'6". Right? It's an inherent attribute that you don't have. Things that market makers have access to, or high frequency traders or hedge funds, there are access features that you don't have, you won't have as a retail trader. So you have to play the game the best you can within your space. You absolutely should understand how these entities work, what they care about, how they behave. But if you try to do what they do, you're going to fail because they're different. So you have to play the game your way. Institutions are out to get to retail sometimes. And it's kind of tricky because the inference from this is that you're playing a stacked game that is only out to hurt you. And it's really not so much the case. There are absolutely instances where a market maker might try to pursue max pain if we're within a couple pennies, because why not? It doesn't hurt them. The problem is, in general, institutions are busy competing with each other. On the retail side, you're kind of just around them in the same space, but again, you're doing different things. So if you apply a victim mindset as you're moving through markets, which is the bigger inference here, it's just going to be a complete hindrance. The next one of my favorites, actually one of the reasons why I started a YouTube channel, is to counteract these kinds of people. Make XX per day, per week, per whatever time frame easy with no time or effort. And in a incognito window on YouTube, I just throw in options trading. And this looks like a good video, the first one. It looks like they're providing just general information. Then the second video, take a look. Options trading in 10 minutes. How to make $1,000 a day. This is a quintessential clickbait video. I don't know anything about him. He might be great, and he might just be playing the YouTube game, not talking crap about Chris. He's probably fine. But this objectively is terrible clickbait designed to trick people into thinking that this is a reality, and it is not. Think of it this way. If you could make $1,000 a day options trading in 10 minutes as a beginner only, who wouldn't do that? Everybody would. There's a reason why trading has such a high failure rate. So don't fall for this kind of stuff. As you scroll through some more, you can see some basic content. This is all good. Teaching people how to do stuff. This is Benjamin's channel. He's a homie, so you should definitely check out his stuff. This is also Chris, another good dude. And then you get down a little bit further, and then we have this. $4,689 in 13 minutes. Again, that can completely happen. There's nothing wrong with that in and of itself. The problem with this is that it's designed to set up terrible expectations for you, the beginner, and make you believe that this is normal, this is common, this will happen all the time. And again, it's just clickbait. It's designed to get you to click through the video. Again, I'm not saying there's anything wrong or that didn't happen. I don't know. But what I'm telling you is that the inference from stuff like this is to make you think that it's common, repeatable, easy, and it simply isn't. The next one, this one's super simple, but everybody messes this up. You'll see things like rolling avoids losses. And again, I go into an incognito window, so it's not skewed by anything that I look at. And the first non-sponsored post is by this guy, and it says, avoid losses by rolling options, which is utter bullshit. It's not what it is at all. I actually would recommend checking out this video that talks about the reality and how it actually works. This isn't just to promote my own stuff, but it's because there are a lot of misconceptions about rolling options, like this one here. I can tell you what rolling isn't. It's not free money. It objectively is not free money. So rolling options, and I'll link to that video so you could check it out. But in a nutshell, it's closing a trade and opening a new trade and tying the accounting together. Whatever the realized P&L of the prior trade was, that's whatever the P&L is. That's what's realized. So rolling trades is literally booking a profit or a loss, whatever it was, and opening a new trade that may overwhelm the prior loss, but it doesn't produce free money. Not how it works. The last thing, trading is hard. This is completely accurate, but inaccurate at the same time. It's kind of a fun topic, actually. The reason why I say that is trading, the actual process of trading is supremely easy. All of the work, all of the difficulty is done long before you click the button. When you're actually executing a strategy and physically trading, that's the easy part. It's as easy as it gets. It's just execution. All of the hard work is done before. This is like people who practice really hard. Kobe Bryant's a great example. And when he was playing games, he would literally talk about how game was like a release because he put himself through hell in training and in practice so that games essentially become easy by comparison. So trading itself overall is very difficult. The vast majority of people will fail. But if you define a process, you go through the effort of building strategies, building a plan that you can execute, that you trust, trading in and of itself, the button clicking component of it is super easy. So what are some other options trading myths or lies you've heard? I'd love to hear them in the comments. Be an outlier. I will see you all later.